Welcome to another episode of Sanlam's In Conversation podcast edition, where we dive into the most important trends and issues affecting the employee benefits landscape. I'm your host, Ulitile Ramashala, and today we're tackling a topic that's created a lot of conversation, some might even say confusion, in South Africa over the past few months, and that is, of course, the two-pot system. I'll be joined by a team of experts to take a holistic look and share insights on the implications of the newly implemented two-pot retirement system on a range of issues, including retirement planning, investment options, fund administration, divorce, and so much more. As you know, this system introduces a more flexible approach to retirement savings, allowing for immediate access to a portion of funds while keeping the rest safely invested for your future retirement. But with these new rules comes a host of legal, administrative, financial, and economic considerations. So whether you're an employer, a trustee, broker, or advisor, or just someone trying to understand how this system could impact you and your future, this episode has something for everyone. On that note, let's get started. I'm thrilled to have Mr. Arthur Kemp, our chief economist at Sanlam, who's joining me now to discuss the broader impact, or economic outlook rather, and the potential impacts on the two-pot system on investments, financial security, and South Africa's economy as a whole. Welcome, Arthur, and thank you for joining me.
Hi, Olatilwe, and thank you so much.
Yeah, let's get started, Arthur. In your view, how do you think the introduction of the two-pot system has impacted the South African economic climate?
Well, I think on margin, not too much yet, really. I think the impact is still to come. We have seen consumers more confident in the third quarter. Surveys showing businesses more confident, but I think that's got a lot more to do with the formation of a government of national unity and an expectation that economic reforms are going to get underway and that the economy is going to grow faster. And for the time being, if we can get the economy, for each 1% additional growth we can get out of this economy, you're creating more than 100,000 jobs. I think that's what's potentially exciting. But two-pot is there, and its impact is still coming over the next year.
Wow, that's true. And since the implementation on 1 September, Arthur, have we seen an increase in consumer spending? And could this impact inflation, even interest rates going into the future?
Too early to tell. The latest data we have, if you look at the retail sales data, for example, from Statistics South Africa, we've got the July data print. That came out in September. So in October, we're only getting the August print. So it's going to be a couple of months before we know. But we know the impact's going to be big in the fourth quarter because there are lots of estimates out there. And I've seen estimates of the total withdrawals potentially initially amounting to anything from 30 billion to 100 billion. Sure. But let's take the 100 billion, which is a high-end scenario. After tax, you could be looking at 70 to 80 billion rands worth of personal disposable income boost in the fourth quarter. We don't know how much people will use of that for spending, how much they would use for paying off debt. As I say, there's a big range of how much the withdrawals will be, but nonetheless, that's bound to show up in consumer spending.
Sure, Arthur, that's quite scary. 30 billion to 100 billion. That's quite interesting. It's probably too early to speculate, but in your opinion, how do you see the two-pot system impacting monetary policy, particularly in terms of interest rate adjustments?
So I think over the next year, if we take, even at the high-end scenario, up to 100 billion rands worth of withdrawals, and you take the after-tax amount of that, plus obviously access to the third contribution to savings pots over the next year. Even if you took that scenario, which is a high-end scenario, then in terms of after-tax spending and the overall boost to the economy, remembering that we still import goods, so if you consume, we still import, which subtracts from GDP, you're getting a contribution very lumpy in the fourth quarter of this year, but overall for 2024, maybe an addition of 0.25% of GDP growth. Next year, another 0.5% GDP growth. That's at the high end of assumptions. And, that's probably not enough to create upward pressure on inflation, or a lot of it. Very, very limited, I think. And therefore, I would doubt that puts upward pressure on interest rates, remembering that we are now what seems to be in a significant interest rate cutting cycle, barring accidents. And then there's the other side of it. The government's going to get their tax contribution because these withdrawals are taxable. And that could amount at, again, high end of the assumptions of about 0.5% of GDP, smaller budget deficit. And the impact on the debt ratio is even higher than that because it's a smaller budget deficit and GDP is larger given relative to the existing stock of debt. So that relative to baseline, the debt ratio doesn't go up as fast anymore. And remember, all else equal, that's also a contribution to where real interest rates are sitting in the economy. So I think on balance, this isn't going to have a material impact, probably a very marginal impact, if that, on interest rate decisions.
Interesting views. And then from a behavioral economic perspective, how might this new system change the way people approach retirement planning? And will the option to access funds early lead to more withdrawals in your view? And what could be the short, medium and long-term economic impact of this?
I think in the long term this does change savings behavior. So if we look at the retirement industry, total contributions a year around 250 billion rand in that region. Withdrawals around 360 billion rand. And the Reserve Bank recently published a paper on the two-pot system, and they indicated in there that more than 100 billion rand of that 360 billion rands worth of withdrawals is resignations. So what you could get, of course, is less, let's put it this way, incentive to resign to access those funds if you're in an emergency. And then, of course, in the long term, what happens here is that because 2/3 of your contributions are invested and you have access to a third through the savings pot, over time that improves savings behavior. So I think in the longer term, this actually on margin should actually improve savings behavior and improve the number of people who can actually retire relatively more comfortably than what is the case now. Of course, what that also does in the very long term is it places less pressure on our fiscus because a high level of unemployment in South Africa today, if you get the government of national unity going and we get economic reforms going and faster growth, we employ more people, plus better savings behavior, that's much less pressure on the government. And because you can see that pressure coming through in social grant spending, which we have to do because you have to support a population that's in such dire straits. But those pressures then one would envisage in the long term start to ease off. In the near term, though, of course, you're going to see significant withdrawals and probably quite lumpy up front. So this is a long-term process.
Couldn't agree more, Arthur. I mean, I think you've touched a bit on it, but I'm going to ask this question regardless. If we see a significant shift in savings behavior or lending trends, could the Reserve Bank then respond by adjusting interest rates to encourage or discourage borrowing?
So if we look at interest rates, there's in the short term, monetary policy is very important in the formulation of interest rates, but in the long term, ultimately, interest rates in the economy are a function of the interaction between savings and investment. So if you think about South Africa at the moment, we've got pretty high real interest rates. And we've got quite high real interest rates in large part because we've got a government that is running large budget deficits, has a high debt ratio, and is absorbing a lot of savings, and that's putting upward pressure on real interest rates. So it's on margin, if you improve the savings behavior of South Africans, then and savings generally improves. And remember, we've got a government now that if we manage to grow the economy faster and we over time start to improve our fiscal position and government starts to absorb less savings relative to GDP, plus you're improving savings behavior of households, that improves overall level of savings, which all else equal puts downward pressure on real interest rates structurally over time. So one would hope that that is the case here. At the same time, we also at the point where I think that in the next few years, if everything goes according to plan and we stabilize fiscal policy, and at the same time that would obviously help bring down real interest rates and create more space for the private sector to take on debt, you might well find that private sector borrowing over the medium to longer term actually picks up. But that would be to hopefully invest and drive the economy. So I think that we need to see this in the perspective of structural forces. All else equal, you improve savings behavior, that puts downward pressure on real interest rates. But we have to then obviously play that off against the fact that South Africa is quite far behind on its investment spending and infrastructure. There could be a lot of demand for investment in that. And over time, if you lift investment strongly, that would tend to put upward pressure on real interest rates again. So you've got to balance these all out. But, to fund investment, the bottom line is you need more savings. So all in, I think this is a good development.
Wow, that's really, really good. And with individuals potentially using their savings pot to avoid taking on new debt, do you foresee any impact on lending markets, such as reduced demand for personal loans or credit? Or could we see lenders rather adapting to new behavior, to new borrowing behavior?
very hard to tell. If you look at the amounts here, even if you're talking at the top end, the sort of estimates of 100 billion rands worth of withdrawals, to put that into perspective, total household credit is standing at about 2.9 trillion rand. And from bank lending, it's about 2.2 trillion rand. So yes, at the moment it's growing fairly slowly. Over the past year, increased by about 65, 66 billion rands worth of lending from banks. So if you take that 100 billion, that's, it's quite big in relative to the perspective of how much debt people have been taking on. But we don't know how much of the 100 billion they'll use to pay off debt or not take on new debt. Very difficult to tell, but I think those numbers sort of put it into perspective that it's not that big in the context of the entire amount of borrowing. For certain individuals, it's going to make a significant difference, obviously. But in aggregate, I don't think it's from that perspective that big.
Okay. And Arthur, is there a risk that individuals might continue borrowing while simultaneously withdrawing from their savings pot, leading to over-leveraging? And how could this scenario impact the stability of credit markets?
So I think the consumer at the moment, if you look at their level of debt to personal disposable income, it's not much higher than 60% of GDP. If you look at the debt servicing cost as percentage of personal disposable income, it's obviously been rising because we've come out of a rising interest rate environment, had our first interest rate cut now in September. But it's not that high relative to history, certainly not anywhere near what we, for example, saw during the global financial crisis, where that debt service cost got over 12 to 13% of personal disposable income. It's materially lower at the moment. And if we're right, barring accidents, geopolitical risk, the rand falls, and inflation is a bit higher than we would like it to be again, and that impacts monetary policy decisions. But on current information, with the Federal Reserve cutting interest rates, with inflation heading lower in South Africa, there's significant scope to cut interest rates, which means that debt servicing cost is going to be coming down. So it is a time now where you would expect consumers to take on more credit. Obviously, if you have access to this type of funding, the previous question we discussed that this is not that big in the context of the overall level of lending. But for certain individuals, they may take this money in lieu of taking on additional debt. Or alternatively, you might find people at this stage of the cycle, if interest rates come down far enough, people haven't been, if buying durable goods for a long time, they might decide this is a good time to do it. They might look at a home, I don't know, and you may use some of this cash as a deposit on an asset. But it is a stage in the cycle where I would expect consumers to take on more debt, and with interest rates coming down, the affordability of that should improve. And as I've said, I think we're in a period the next few years where if we do see over time the government debt ratio stabilizing and eventually coming down, if we do get to that point, government absorbing less savings, if fiscal policy stabilizes, you could find that the risk premium priced into South African interest rates is reduced, so interest rates come down. That could be a natural period for the private sector, both companies and individuals, to borrow more anyway. Of course, for individuals, the individual circumstance would differ, but I would see it that way in aggregate.
Okay, thanks, Arthur. And lastly, are there any international examples that stand out as example for South Africa to learn from? And if so, what lessons can South Africa learn from the economic outcomes, particularly concerning savings, lending, interest rates, and inflation?
Now, the popular one is Chile, because Chile saw a very high level of withdrawals. I mean, we're talking about round about 1% of GDP, a little bit more, potentially at the high end of withdrawals. In Chile, it was 14 times more as percentage of GDP. So you saw a very big boost to consumption. It happened in late 2021, early 2022, when the economy was recovering from COVID, so it was growing very, very strongly. So it was difficult to pick out how much of this impact, the growth in GDP, came from the withdrawals, but they were big. And obviously the tax take was also quite significant, but it got to the point where the government then actually stopped it because the pension fund assets were declining, and it had an overall, from that perspective, savings perspective, obviously a negative impact. So that sort of with those amounts of withdrawals and the kind of spending that would come from that, one would imagine in an economy like ours, where our potential growth rate is still quite low, and you put that amount of demand on it, then that could potentially put significant upward pressure on interest rates through higher inflation, prompting but the way ours is structured, we're not talking about that type of a scenario. Okay. I think that given the rules of our system, I think that, as described earlier, don't think it's going to have an impact. We're going to see it, certainly in the fourth quarter on a quarterly basis, and there'll be some impact, but not big enough, in my view, to change the overall big picture for the South African economy like that.
Okay. Well, thank you so much for joining us, Arthur. I certainly learned a lot from your views, and look forward to having you again.
Thank you, Olatilwe. Appreciate it.
Thank you so much. Well, that was Mr. Arthur Kaplan, our Chief Economist at Sanlam. Thank you so much for taking the time to join us.